Okay, we are letting people in right now. Hello, Hannah. Hi, Tammy. Hi, Leonard. Hi, Kim. Okay, so while people are logging in, I will go ahead and do my intro. So welcome everyone, and thank you so much for joining this week's Small Business Essential webinar. This is year-end tax planning for small businesses. My name is TJ Daniels, and I am the Iowa Center's Women's Business Center Director. The Iowa Center's Women's Business Center is funded in part through a cooperative agreement with the U.S. Small Business Administration. You will all receive an email after this event from my colleague, Sierra Smith, thanking you for attending today's session, information on how to connect to our speaker, as well as a form to complete. Please do us a favor and take some time to fill this form out. This information allows us to continue providing free educational programming for small business owners in Iowa. Now, go ahead and take some time to locate the chat function on your Zoom screens so you can join the conversation by asking questions and or adding comments. Also, feel free to introduce yourself and your business in the chat and include your website or social media page so we can visit and learn more about your business and network. Now, a little information about today's speaker. Our speaker today is Max Miller, a certified public accountant with McGowan and Associates in Clive, Iowa, a firm specializing in individual and small business tax planning and consulting. He has over 12 years professional experience ranging from private industry accounting to trust estate administration to public accounting. A majority of his experience is with helping clients with individual and small business tax issues. Max is also an active mentor and board member with Everybody Wins Iowa, a reading and mentoring nonprofit in Central Iowa. Now I will hand the screen over to Max.
Okay, thanks everyone. Thank you for the intro and everyone for joining. We'll get right into it. I tried to cover a wide variety of topics. If you have any questions that need a little more detail, feel free to ask those. And if it's something that we maybe need to talk about after the session, that works too, because you'll be getting my contact info. But the first slide is review year-to-date financials. So in order to really make any good informed tax decisions, you need to have good data behind that. So in your accounting system, you need to make sure that everything's captured. And, kind of the focus of this, especially today, is make sure we have everything ready before year end. Once we get into next year, that's really when we'll file the tax returns. But in order to make any decisions, you likely need to have everything figured out during the calendar year, assuming everyone's a calendar year taxpayer, which I assume you all are. And so the first bullet point is to make sure you have everything captured. I assume most people are using QuickBooks, and QuickBooks can pull in your bank information automatically. So make sure that's happening. But I know that especially in small businesses, you could have multiple accounts, and you just need to make sure that everything that's a business expense is being captured. And so if you have multiple accounts, credit cards, things like that, if it's not being pulled in automatically, make sure you're inputting into your accounting system whatever other business expenses you have. It's very possible you could have cash transactions that don't really go anywhere. And if you have credit cards, if you're just showing the credit card payment, make sure that you're breaking out those expenses based on the categories that they need to be. And then once you think you have everything captured, just kind of take a look over it, and you know what happened during your business year. Are you missing anything big? Is anything jumping out at you? Did you have large purchases or loans that maybe need to be, moved from the profit loss side to the balance sheet side? Just anything jumping out at you right away. And once you then get all of your data input, all of your income and expenses input, then it's a good idea to compare that to your prior year data. And if you have multiple years, the more data, the better probably. And especially if you have a budget, how are these numbers comparing to your budget? So hopefully your accounting system allows you to pull comparative reports so that you can look in one column on the current year, one column in the prior year or the budgeted year, and just go line by line and look to see what has changed. Have items increased or decreased? Were the increases or decreases expected? And if they weren't expected, maybe they're easily explained. If you had planned to buy $10,000 worth of computer equipment, and that was in the budget, but you only spent $5,000, that's a pretty easy explanation. If there are other discrepancies that can't be explained, maybe you need to look into that further. It's possibly things are just miscoded, or maybe there were certain expenses or income items that really didn't fall into what was expected for the year based on budget or what you had done in prior years. The next slide talks about other personal income that you have and how that impacts your business income. And this is a bit more complicated and a confusing issue a lot of times. In most cases, you're going to be organized as a sole proprietorship or maybe a partnership, and a lot of your income or all of your small business income is going to be taxed along with any other W-2 jobs you have, any interest or dividend income, anything else. It all gets compiled together in one way or another on your individual Form 1040. That first bullet point, though, unless you are operating as a C corporation, that would be the only entity structure that would pay its own income tax. Everything else, sole proprietorships, we report those on a Schedule C, which is a schedule within the 1040. And then partnerships and S corporations, those are pass-through entities, meaning the taxation is passed through from the partnership or corp level and taxed at the individual level. If you have a partnership or an S corp, you would have a Form K1, a Schedule K1 that you would use to prepare your individual return and report the income and expense items there. And then that last bullet point, wages from another W-2 job, maybe one spouse has a salary job or a part-time job and the other spouse runs a small business. It's all taxed together. There's no separate tax rates. There's no different scale. And so anything you make throughout the year, it is all combined. So it all kind of affects your overall tax situation equally. Obviously, if you have a W-2, you have taxes withheld, and that helps to cover the tax impact. But if you have other income, if your small business is profitable, then you'll need to look at possibly paying estimates if it cannot, if the withholding tax does not cover your tax liability at the end of the year. And that kind of leads me into the next slide. So do you need to make an estimated tax payment prior to year end? The IRS assesses what's called an underpayment penalty if you don't have paid in the lesser of 100% of your prior year's tax or 90% of the current year tax. And that number does change if your income in the prior year was 150,000 or more. Then you would need to pay in 110% of the prior year tax. And this includes all taxes paid in, including withholding from a W-2. So back to my example of if one spouse has a W-2 job and the other spouse is running a small business, you would include any taxes withheld from the W-2 when you try to figure out, if you need to make an estimated tax payment. Typically, these are paid quarterly. And then, one thing to note, especially this year, while the fourth quarter due dates are not until the following year, so in this case, it's tax year 2022, the fourth quarter Fed and Iowa estimates are not due until January of 2023. However, in order to get the benefit in the current year, you do need to pay the tax in December in calendar year 2022. One caveat to that now is, or I guess one reason to especially do that this year is starting in 2023, Iowa has eliminated the ability to deduct federal taxes paid. There's a few other items that are going away in 2023 to make it a little more simple, and the tax rates are decreasing going forward, but as rates decrease, some of the deductions go away as well. So if you know you need to make an Iowa estimate, it's possible that Iowa will allow it if you pay it in 2023, but that's still a little up in the air. And so at the firm I work at, we're recommending everyone make their Iowa estimate this year in December of 2022. And that's really not changed, although now you just may lose that deduction if you don't make it this year. One thing to kind of back up that idea to deduct the taxes this year, you want to accelerate your tax savings as much as possible in almost every case. And so if you wait to pay your taxes January 1st, you don't see that benefit until you file, in this case in April of 2024. Whereas if you made the payment December 31st, you can see the tax savings whenever you file for 2022. April of 2023 would be the deadline. A few years ago, the federal limit on the federal return, as long as you itemize, you were able to deduct whatever level of state taxes as you had paid. There's now a $10,000 limit. So on top of needing to itemize within the itemized deductions, which the standard deduction for a married couple is around $24,000-25,000, only $10,000 of that can be state taxes, and that includes all state taxes. So any state tax withheld from your W-2, any state estimates paid, but it also includes state property taxes or your county property taxes or vehicle registration fees. That can only go up to $10,000 that's tax deductible. And so if you're at that limit, it probably doesn't make sense to make your state estimate in December, because you're not going to get any more benefit beyond the 10,000. And so you could wait and pay that in January. But the big one is paying any federal estimate, especially if you're a taxpayer in Iowa, paying any federal estimate yet this year by December 31st of 2022.
Here we have a question. It says, how is an LLC taxed?
Sure. So the question was, how is an LLC taxed? And this could be several ways. If you're a sole proprietor and you have not elected to be an S corporation or a C corporation, in that matter, when you set up the company, in most cases, you're going to file a Schedule C. And so this is just a separate form within your Form 1040 that you're reporting any revenue you've made, any expenses, and it's just a separate schedule. And then that net amount gets added to your tax return. So it's not a separate filing. It's just part of your own individual income tax return. Now, if you do elect to be an S corporation, which I'll touch on later, that is a separate filing. But even then, the net income or loss from that entity still gets taxed the same. So the key thing is, as long as you're not a C corporation, which they're quite rare, everything is in one form or another flowing into your individual tax return and getting taxed just like any other ordinary income that you make, any other wages. It's all taxed at the same rates. Okay. Moving on. And so this slide talks about kind of something you can do between now and the end of the year to help your tax situation. So, how can large purchases impact tax situation? It just may be helpful to do it this year. The thing to remember is if it's something that you weren't considering purchasing, it probably doesn't make a lot of sense to purchase it just to get the tax impact, because the highest tax rate is, you're probably looking at 40% between Fed and state. For most people, it's probably closer to 20 to 30%. And so whatever you buy, assuming you can deduct all of it, which in a lot of cases you can deduct the full cost, you're really only saving that tax percentage. So if you go out and buy computers for $10,000, maybe you're saving $3,000 of taxes. But if you didn't actually need the computers, you're still out, $10,000, $7,000 net after tax. So it just doesn't make good business sense to go out and buy things that you don't need. However, if it's something that you'll need soon, and soon could depend on your business needs, but probably within the next year, or certainly within the next few months, if you need to go out and buy something, new equipment, a new vehicle, maybe possibly make improvements to the space that you're in, if you can get that done this year, as opposed to in January, February, March, you'll accelerate your tax savings into the current year. And it also has an impact on, well, maybe you're already in a loss position this year, and next year, you're going to have more income. In that case, you want to maybe push the expense forward into next year. It all depends on what your taxable income looks like this year versus next, or what it would even be more years down the road. It's hard to always know what the future is going to hold. But if you do know that, well, maybe my income is going to be consistent year to year, probably makes sense to accelerate some expenses. Like I said, if you're in a loss position now, depending on what other income you have, obviously, because everything's taxed together, it may make sense to push some of those expenses forward. But in most cases, I'd say if there's something coming up very soon that you have the cash now, you're able to make the purchase now, a lot of times it will make sense to get that done at the end of the calendar year in December. And the last thing I have on there is that this holds true for bonuses or possibly retirement contributions. If you do have a retirement plan or employees, obviously this won't apply to everyone. But a payment of a bonus is a deduction, just like buying a new computer. It's all dollar for dollar. And so if that's something that you were considering, and that would be another kind of easy way to reduce your income in the current year. All right, the next few slides kind of talk about more maybe administrative things, or just things to think of, especially at the end of the year, just to kind of keep things organized. And this is talking about accounts receivable. And again, this may not apply to everyone here either, but do you have customers who are behind on payments? And behind could mean different things to different companies and different businesses, obviously. Do you have any procedures or policies in place? And what's your plan to reach out? I think it's just a good business practice to have plans in place that you're not relying just on memory, or you come to think that someone hasn't paid you all year. It's good to review this however often your business would need, whether that's monthly, quarterly, and just have a plan to reach out and collect on your payments. And at the same time, is there a policy to write off old receivables? And some of this really won't affect a lot of people. It depends on your accounting method. But it's a good idea to keep the list of receivables current and up to date. If you have something on there from 5 years ago and the person's left town and there's no chance of collecting, that'd be one that you would write off. Important thing, especially with the IRS, is just be consistent with your policies to write off what you would call bad debts. When you write off an old receivable, that's considered a bad debt expense. Just be consistent year to year. Obviously, there's circumstances change, and if you write off a bad debt and someone does come back and pay, that's no problem either. You just record that as income again. But keeping your list up to date, reaching out based on whatever policies you have, and just being consistent are good practices going forward. Next is payroll filings. If you have employees, you need to file payroll reports, make payroll deposits, weekly, monthly, quarterly, whatever it may be based on the size of your business. Make sure everything at this time of the year is up to date and you filed everything that you need to timely and accurately. And then, looking forward to the fourth quarter and your year-end reports, and just making sure that you have the information you're going to need to get the payroll reports done. W-2s are due at the end of January. And so you need to have, there's often some odd kind of one-off things that need to go into maybe the final payroll of the year, at least the annual report. And then on the W-2s, things like maybe bonuses at the end of the year. And then if your company has a retirement plan, retirement contributions, and any healthcare costs associated with providing employer health care, or if the employee pays a portion of that. I guess the point there is just to be as organized as you can, because December, January is a busy time for everyone, and important not to let the payroll filings to the last minute, because they are so important to your business, and the penalty for not filing can be quite steep. And it's just a lot of paperwork at the end of the year, I think, across all businesses. And so being organized as early as you can will really help when that time comes to file the reports. One item I have on here is talking about the employee retention credits as it relates to payroll. This may be a separate webinar. There's a lot to go through on this issue, but if you haven't heard of the employee retention credit and you do have employees, you are able to still file amended payroll reports to collect the credit. I believe you have until April and this relates to the pandemic, so tax years 2020 and 2021. You still have until April of 2024 to file amended payroll reports for 2020. And kind of the short version of this credit is, if you were mandated to shut down during the pandemic, so March of 2020 through whenever, if a government entity, the state in this case, most cases, required you to shut down. So if you were a restaurant in March, you were required to shut down by the governor's order. You would be eligible, assuming you kept employees on payroll for a certain percentage of their payroll costs for that year. If you are in a business that was not mandated to shut down, at least fully or partially, you can still qualify if you had a decrease in revenue. So if you look at your second quarter revenue, and it's revenue and not net income, if your second quarter revenue for 2020 decreased by 50% compared to the prior year, so the second quarter of 2019, you would qualify. And for 2021, you compare maybe the first quarter of 2021 to the first quarter of 2019, that only needs to decrease 20%. So as long as it's 80% of your 2019 revenue in a quarter, you would qualify for at least some of the credit. And the credit's quite lucrative. If you have employees and you kept employees on through the pandemic and you qualify, it can be tens of thousands of dollars per employee. And so it's really important that you look into this if you think you might qualify. Also be a little wary. The IRS just issued a kind of a warning that there's a lot of businesses reaching out to companies talking about the employee retention credits, and they're quite aggressive in what they say can qualify, and whether they're right or wrong is yet to be seen. It may require some IRS audits before some get disqualified, but the fact that the IRS is already reaching out about that is a little worrisome. And some of the signs to look for when these companies reach out, if they're asking for fees up front to look at it, if they're asking for a percentage of the credit that's coming back, that can be kind of a red flag, and something that you'll just want to be cautious of before maybe going into business with them. Yeah, they know the credit, they're aware of what it is, but if a company is asking for a percentage or fees up front, they have a lot of incentive to make that credit as big as possible. And you just don't want to get into a situation where you've kind of filled out fraudulent reports based on bad information and getting in trouble with the IRS down the road. So that maybe sounded worse than it actually is, but just use common sense, and reach out to your trusted advisors that you work with before you start going down that path, is what I would say.
We have a quick question.
Sure.
Are employers with 1099 employees qualified for ERC?
Yep. So the question is, if you have 1099s versus W-2s, would that qualify? And it would have to be employees and not 1099 contractors. So you're amending your quarterly payroll reports, and any 1099 payments are not reported on there. So it's strictly wages. It's strictly true employees that are receiving paychecks, and employment taxes are withheld, and they're filing quarterly payroll tax reports. Those would be the only people eligible to receive the credit. Leading right into 1099 reporting. And so a lot of you may have people that you pay for services that are not your employees. So they're not getting W-2s, you're not withholding taxes, but you do need to issue them a 1099. Anyone performing, where you see this a lot, is people performing services for you. There are other types of payments that require 1099s, although much less common, I would say. So in most cases, someone performs a service for you, it was over $600, you need to issue them a 1099 unless they tell you otherwise. And a few years ago, there is a new form to report non-employee comp. So someone who performs services for you but is not your employee, exactly what we're talking about. Those are reported on a 1099 NEC instead of the old way, which would have been a 1099 MISC for miscellaneous. The miscellaneous form still exists, but it's for things like rent or third-party payment providers or royalties. Again, a lot of kind of the less common payments. And much like your W-2s, 1099s are also due to the recipient by January 31st. So it's really important to get all the information in, collected now. You don't want to be scrambling on January 30th to get this done. The easiest way to get the 1099 information is upfront. So before someone even performs a service for you, if possible, have them fill out a W-9. A lot of you, I'm sure, have seen a W-9. It's a request for taxpayer identification. So they fill it out on their own, their name or their business name, type of business, social security number, employer identification number, and then they sign that, certifying that that's their information. So get those as you go along, as people are doing work for you, and you're going to miss some. And so towards the end of the year, now would be a good time to start reviewing that list, seeing, who have we paid that's over $600? Do we have their information? That way you're just ready to go in January to fill out those forms. Again, much like the payroll, just a lot of paperwork at the end of the year. And the penalties for missing a 1099 are quite steep. And so you don't want to miss this reporting requirement, much like you wouldn't want to miss a payroll report. And so gathering the data as soon as you can and making sure you have everything to go at the end of the year is key. Okay, so we talked about it a little bit earlier, and this is really just something to consider. If you already have an LLC, it may make sense to elect S status. So if you're a sole proprietor organized as an LLC, or not organized as an LLC, either way. Any income that you're making, it's subject to income tax, much like all of your other ordinary income, all your W-2 income. But it's also considered self-employment income, and so it's subject to a self-employment tax. You'll see on a W-2 that you have Social Security tax and Medicare tax withdrawn every paycheck. Your employer also pays Social Security and Medicare tax on your behalf. If you're self-employed, you're responsible for both halves, and this is reported and calculated on your individual tax return. And so you do get a deduction for the employer portion, so the net impact is somewhere around 11%, 10% of self-employment tax that you're going to pay because you have self-employment income. Now, the way to avoid at least some of this is to elect to be an S corporation. And this means that, you know, the income is still flowing through to you, but you're no longer self-employed, you're employed by the S corporation. So you do need to pay yourself what the IRS deems a reasonable salary, and we can touch on that later. But by taking a salary that's considered reasonable for the work that you're doing within your S corporation, you avoid that self-employment tax. You're still paying payroll taxes, much like any other employer would. But if you made, let's just say 100,000 as a round figure, and you took a $40,000 salary, you're only paying employment taxes on the 40,000. The extra 60 is only subject to income tax. Whereas if you were just a sole proprietor filing a Schedule C, all 100,000 would be subject to both income tax and employment taxes, self-employment taxes. So the S corp helps you save kind of that difference between what's the net income of your business and what's a reasonable salary that you can take from that. It does come with some costs. You would have, there's an IRS form to file the S corporation. An S corporation needs to file its own separate tax return on Form 1120S. So there's just going to be some additional, tax, maybe legal fees, just additional administrative costs to running an S corp, on top of you now have payroll forms to file as well. And it's possible you would only file annually. Some businesses just take the salary at the end of the year, although with cash flow, it probably makes sense to do at least quarterly or even, monthly or biweekly or whatever you need to do. But you will have payroll filings as well. So with those additional sort of administrative costs, it doesn't really make sense. If your business is making $10,000 a year, the savings probably isn't there to elect S. There's no magic number, but the difference between whatever salary you're taking and the income of that business needs to be enough to cover any additional costs that you have to have this separate entity and the separate filing. And those are my tips. I'll open it up for questions. Again, not everything would have applied to everyone, but hopefully there was something in there that you can take away or at least get you thinking about what you need to do between now and the end of the year. And some things, like the employee retention credit or the S corporation, those probably definitely require even more in-depth, finding another webinar specific on those, or reaching out to the advisors that you work with to get some more information on whether or not those make sense for your business.
Okay, so here is a question. What are some common pitfalls that you, what are some common pitfalls that you see for small business owners come tax time, such as likely audit risk, common mistakes, or misunderstandings?
Sure. Yep. So the question talking about small business pitfalls around tax time, audit risks. I guess I'll start with audit risks. As long as you have, it is important to document information But just because you're showing a loss or you maybe didn't make as much money as you'd hoped, that's not necessarily an audit risk. It can, a trend of that over many years, the IRS may look at it, but things like if you don't show any revenue. So if you have a bunch of expenses, but you made $0, you sold nothing during the year, that's probably a red flag. If it's your first year, that's probably fine. I don't know that the IRS would look too much at that, but if you've been in business a while and all of a sudden you have $0, or if you've shown $0 of revenue multiple times, that's probably a red flag. One thing that we're seeing a lot is the IRS really looking at travel expenses a lot. So just making sure that, any travel you have has a business purpose. And this really goes for any expense. You're going to have expenses that have both personal and business use that come up. Just making sure you document the business, obviously what the business need is. If you have something that's split, what was the rationale behind splitting it? You see this a lot with personal vehicles or your office use in your home. And you just need to be reasonable. And it's possible to have a vehicle that's all business, but if you don't own a different vehicle, the IRS is going to really question that as to, how did you only use this vehicle for business if you have no other mode of transportation? And there's a couple ways you can handle vehicle expenses specifically, but I think reasonableness is the answer there.
Okay. Same question. Basically, they're asking about home office and vehicle deductions.
Sure. So I'll start with vehicle. So if you are using a vehicle for business use, you have one of two options. You can take a standard mileage rate, which I think currently is 62.5%, somewhere around there. It's gone up quite a bit as the price of everything has gone up. And so how you handle the mileage rate is, keep a log of when you're using your vehicle for business, starting mileage on your odometer to ending mileage. And then you can deduct 62.5% of any business miles you take. You can also do actual expenses. And so this is a lot more complicated, but in certain cases it may work out, especially if you're buying a new vehicle, because then you're taking depreciation on that vehicle. You still need to know the business use, and the best way to do that would still be mileage. So if you drove 10,000 miles in a year and 5,000 was for business, then you'd add up all of your costs. So gas, tires, oil changes, any repairs, cost of the vehicle if you bought it during the year. And you take that times the business use percentage, and then that's your deduction for business. Similar concept for business use of your home. So if you have a space and it does need to be dedicated for your business, the IRS is pretty strict on that, and you see a lot of court cases where they do get denied. But if you have a home office that's, let's say 100 square feet and your house is 1,000 square feet, then you have 10% that is deductible, and you would take all of your house expenses, including the cost of your house, as depreciation. So the depreciation, utilities, property taxes, mortgage interest, and you take that times 10%, and then that is deductible. And that's really something that if you do work from your home, you don't want to miss that, because that's a significant expense, and you've already obviously paid it. And so you do want to make sure you get the deduction for that. And same as the vehicle, you're obviously driving places. If you have a business use to go there, make sure you're tracking your mileage. They do want to see a log. The more documentation, the better. It's just, if you throw on and say that you drove 2,000 miles last year, and they come back and say, well, where did you go? Why was it such a round number? Those are kind of things that they probably wouldn't trigger an audit, but if you did get audited, those were kind of things that an auditor would look into more and try to disallow.
Okay, quick question. Does driving to my office count as a deduction?
No. So the question is, commuting basically, and commuting would not count as a deduction, assuming you have a dedicated workspace that you consider your office. Driving from home to there would not be a tax deduction.
Okay. I've never worked with a CPA. I've always used TurboTax. I've made enough this year. I think I need to hire someone to help me know if I should file as an S corp and how to do this. How much do CPAs normally charge?
Sure. So the question is, how much do CPAs normally charge? I won't be able to get too detailed on that, but most will charge an hourly rate for their time. Something like, meeting to talk about an S election and then subsequently filing the tax returns, you're probably looking at as low as $300 to $500 to $1,000. And some places are more. It just depends on where you want to go. But I would say you could get that done for under $1,000 a year. Obviously, then there's payroll on that, and I know QuickBooks does a good job of payroll reporting. So if maybe that's a question of just doing it on your own to start, or if you need to hire someone that'd be on top of that. But I don't know, it varies a lot. Most would charge an hourly rate, but there's people out there that I think are more reasonable than others, I guess.
Okay, a question that I actually get a lot. What is the difference between a bookkeeper and a CPA, and like when do you use the one or the other?
Sure, yeah. So difference between a bookkeeper and a CPA. CPA is someone who can sign a tax return, represent you in front of the IRS, in front of a tax court if needed. It's just kind of its own designation. You have to have a certain level of education. You have to pass a test, keep up with, I have to do 40 hours of continuing education a year. And so it's really more to get someone who can sign a tax return on your behalf as the preparer and represent you in front of the IRS if needed. A bookkeeper would be someone who is doing kind of just the ongoing accounting. So each month or each quarter, someone who is inputting information or making journal entries to make your books look more clean or more accurate. And I guess in my situation, we have bookkeepers in my office, and so they would do kind of the ongoing monthly work with the clients, and then as the tax preparer, as the CPA, I would kind of be more in a reviewer role. And in a lot of cases, you can find a bookkeeper separate from a CPA firm. It might be a little more cost effective that way, but I would say the difference is your CPA is probably your more trusted advisor, someone you're going to for advice or questions, and your bookkeeper is there just to keep you up to date with all of your accounting.
Okay, another question. I am currently using only Excel and Shopify for record keeping for my online business. Do you think QuickBooks can be self-taught? Is there a course you would recommend?
Sure.
Okay, I will cut in just really quick. We will be offering a session teaching QuickBooks probably in January, February. Sign up for our newsletter online and you will find that information. But next.
Okay, yeah. I think QuickBooks is easy to use, but I think it is good to start somewhere. So if you can take a class like they're offering here, that would be a great start. I think once you get the hang of it, it gets better every year. It kind of starts to kind of automate itself a little bit the more you use it, but you do need to have a little bit of knowledge just to get started. And I think taking a class that's offered would be a great start. And nothing wrong with, Excel. But I think once you start using QuickBooks, it's just going to make your life a lot easier. There is a cost to it. I'm not quite sure what it costs anymore.
The small business version is like $14.99 a month.
Yeah, so $15 a month. So you're looking at less than $200 a year. And so that's really, really affordable in my opinion. And it, yeah, if you're nervous about, it's such a big system or it's going to be too complicated, I wouldn't worry about that. Taking a class or two at the start in QuickBooks has their support's really good, and they have a lot of videos and kind of chat features that can help you if you get stuck. But I would definitely recommend that. It'll make everything a lot cleaner for everyone involved, for you, for your accountant if you use one. It works with a lot of different programs. You can pull it into TurboTax. It's designed for the small business owner to use, and I think it does a good job of that.
I will just add that when you start using QuickBooks, that is probably going to be the most work you have to do, is when you start to initially enter in a lot of those expenses that you have. And I will say, entering or categorizing those expenses properly is the main thing that you'll need to worry about. We always say trash in, trash out. I use my personal QuickBooks as an example in our classes, and everybody gets a big laugh out of it because I am known to put owner deductions into my QuickBooks. You don't do that. So keep a lookout for those classes. They're really, really helpful. If anything, I always say just get started, even if it is Excel, even if it is just pencil and paper. Get started with keeping those, keeping track of that and making sure that you make those deposits of your revenue. That's the number one start. And knowing those categories when you first start and entering those into QuickBooks will get you a far ways. Like Max said, QuickBooks is integral, and I'm not a sponsor for QuickBooks or anything. I've just used it a lot, and it is very, very user friendly. It's helpful. So I'll just throw that out there. Let me see. We have a few more minutes. If there's any more questions, go ahead and add those into the chat. We see any incentives for employers with 1099 employees, unlike ERC for W-2 employers.
Yeah, and the question talking about if you have 1099 versus W-2s, and unfortunately with the employee retention credit, 1099 payments would not qualify. Additionally, any payments to owners, if you have even payroll in your S corp, in your entity, to one of the owners, and there's some family rules there too, then those would not qualify either, unfortunately. So it really comes down to a true W-2 employee withholding payroll taxes that's not you, your spouse, or your kids, basically.
Alrighty. Let me know if there's any more questions, but I will go ahead and ask the question that I asked all speakers. What is the one piece of information that you want all of our clients on this webinar today to know?
Sure. I think the overall, my message is just keep good records. Make sure you keep documenting what you have, and you can always fix mistakes. Don't get too worried that something's in the wrong place in your books. That's an easy fix. Just as long as the expenses and the income that you're receiving is, what it is and what it's for, and you've documented that, the accountant or whoever you work with can figure it out in the end and fix any mistakes you make. We don't need to be perfect all the time. Just get it as good as you can. And the better records, like TJ said, trash in, trash out. So the better records you have, the better information you're going to have to help you make decisions at the end of the year and really throughout the year.
All right. Thank you so much, Max, for taking the time today to share such valuable information with our audience. And thank you to the audience for being here, engaging, and asking questions. I wanted to take a moment to share some information about some of our upcoming programs. One thing that we have every Tuesday in person and virtual is our small business accountability group at 11 a.m. This is where entrepreneurs meet to share their business goals, report successes, share knowledge, and support each other in reaching those goals. It is a work session, so please feel free to check that out. On December 6th, we have our next SBE to close out the year, ready to make it happen in 2023. That will be an interactive goal setting session. Then that Thursday, we will have our learning lab, which is an in-person goal setting session. So please come to network, share, and set goals for 2023. Also remember the Iowa Center's other services, such as our volunteer income tax assistant program, where we help clients with their personal taxes year-round, and the Iowa Center's loan funds. If you would like more information, feel free to check out our website at theiowacenter.org. Don't forget to sign up for our newsletter and follow us on social media. Thank you everyone for joining us today. Hi, Pan. Hi, Ms. Gregory. Hi to everyone that I see out here. With that, I will close with my piece of advice for us all. Love what you do and do what you love. Have a great afternoon, everyone. Oh, yeah. Close.